Welcome back to the channel, guys. My name is Warren. I am a banker here in London and a property investor across the UK. My goal is to live free and independently from property. So I'm looking for an income of £3,000 per month from property. If that's what you're onto, like, subscribe. That is what my content is all about. So here's a riddle for you guys. When is a mortgage offer not really a mortgage offer? Did you know that there are different types of mortgage offers that you can get at different stages of the buying process when you're buying a property, but only one of them is a legit, bona fide, real deal mortgage offer that you can proceed to completion with? Can you tell me, without going through the rest of this video right now, what the difference is between being sent by a broker a mortgage option or mortgage options, a decision in principle, a mortgage illustration, and a mortgage offer? Let me know in the comments below if, before you watch the rest of this video, you knew or know already what the difference between those different types of offers is, because only one of them, as I said, you can take through to completion. The rest are illustrations, indication, potential, okay? And they could all be taken away at any time once further underwriting is done. And you need to know this, right? You really do need to know this. And the reason why I'm making a video on it today is because I myself have been in a position recently where I was buying a property and I'd had a decision in principle from a lender, which I took to the sales agent and the seller, and it was all good, offer accepted, all gravy, right? Wrong. I went back to the broker after the offer was accepted and everything was looking to progress on to the next stage. The broker said, right, we're going to go in for the full mortgage offer, right? So we need to do the underwriting, the searches, the credit checks, etc. And what happened, guys, was that the lender, and tell me if this has happened to you at any stage or if you've heard about it happening to anybody else, they then came back and said, oh, actually, based on our full underwriting, so as I said, that includes searches on your credit file, it involves evaluation of the property, etc., etc. We're actually not going to lend.
So we don't have the capacity.
So I'm stuck. I've committed to a purchase. I've already paid fees to my solicitor, my broker, etc. And now I actually don't have the money to buy the property. So what happened? I had to basically spend the next few weeks, the next month or so, frantically going to different brokers, going to different lenders and trying to get a plan B mortgage offer because the first one, the plan A one, fell through. And I'm going to share a few things with you that are really going to help you to hopefully never be in this position by taking preventative measures, especially relating to your credit file, your credit report, your credit history, whatever word you want to use, because that's a really big component of the full underwriting process with you to getting a mortgage offer alongside the lender valuing the property. So the first thing I'm going to start off with, guys, and this is going to be really subtle and nuanced, but it's really important to push your broker on this. When you tell them that you're going to offer on a property, buy a property, and you want to understand how much you can borrow, they go through it in stages. What some brokers may do is do a real high level indication of how much you might be able to borrow. I don't know the specific ins and outs, but it's something along the lines of plug in some numbers into a system on their end relating to how much you earn, what your budget is in terms of your month to month spending, and some other details, and you'll get mortgage options, okay? I got this from a broker, I won't say who, but it's quite clear to me reading this that this is a really high level indication. I would question if they've even actually gone to the lender and fed the lender my information, like my tax returns, my earnings, my budget, my wage slips, my bank statements, etc., to get an indication of what I can borrow. So that is the first indication of borrowing that you get from brokers. Now, I don't like this, okay? This is too generic for me. What I actually want is a decision in principle and a mortgage illustration, okay? Those are two words that you really want to memorize and say to the broker when you're talking to them about how much you can and want to borrow before you go see properties. Now, you also want to make sure that it's based off of a soft credit search. A soft credit search is different to a hard credit search. It's called a soft credit search because it doesn't show up on your credit report. You might get an alert saying that a search was done on your credit file, but it doesn't show up, it doesn't change your credit score, okay? That is the closest thing to a mortgage offer before you go into full mortgage underwriting, once you've made an offer and then they go in and they do a hard credit search, evaluation, etc. So that is what I like to get from brokers, but not all brokers will give you this, okay? Most should, but I have personally been in contact with about 4 or 5 different brokers for the same one deal, and I've gotten different things from those different brokers. So it's really important to ask for the right type of decision in principle based on a soft search of your credit file, so that you're in a position where you're not set up for failure further down the line. And that decision in principle can come in different forms. It could literally just be the name of the lender, the amount that you can borrow, the interest rate, the term, and some other details. Or it could be a full, what they call illustration. So pages of information. It has those elements that I've just said before, but it also includes stuff like fees, charges, legal costs, etc., etc. It's just more detail. So either of those two is what you want to get from a broker and a lender before you go and view properties and make an offer. Now, even then, guys, even then, say you've got a decision in principle and mortgage illustration based off of a soft search, you're still not guaranteed to get a mortgage offer when it comes to the full underwriting. Why is that? It's because they basically go into even more forensic detail. I mean, these people are in your life. They're in your bank accounts. They're going through, 3 months worth of transactions line by line. They're looking at your work contract. They're looking at the taxes you pay. They're looking at your tax returns. And on top of that, they're doing stuff like valuing the property, etc. So there's a lot of components that come after you've made an offer that could still swing a lender's decision. But, it's pretty much out of your hands. Now, how can you basically try your best to ensure that that decision, more often than not, comes back in your favor? So what can you control? This is where we get into your credit report and your credit history, okay? So me personally, I'm going to give some direct examples of stuff that's good, that positively affects your credit report. This is really important stuff because it's basically like dating, right? It's basically like going on Tinder, looking at a profile. Say you are, as a borrower, the profile, and is it swipe left or swipe right? I don't know, I'm married, right? But I think swipe left is a yes and right is a no. If it's not, let me know in the comment section below. But for a yes, you're going to have at least some of these factors that positively affect your credit file, okay? The first is having active and long-standing credit accounts, okay? Now, what is a credit account? A credit account is, according to the big 3 credit agencies being Experian, Equifax, and TransUnion. A credit account is a mortgage, a bank account, okay, just a regular bank account, any loans, credit cards, utilities accounts, so like British Gas, Thames Water, any insurance premiums, okay? Those, you want to have those types of accounts on your credit file. Now, some people might think counterintuitively, they might be like, well, no, if I don't have any loans or any credit cards, surely that's a good thing. I'm not borrowing, I'm using my own money to pay for everything. So surely that's a positive effect, but it's actually not. It's not a bad thing, but having a credit card and a loan, you're basically demonstrating that you can take out credit and you can repay it on time and settle it over time. And if a lender's looking to do that, they want to see that you've done that with other lenders, okay? I hope that makes sense. And a long-standing account is anything over like 3 years, basically. So at 3+ years, so I'm talking a credit card that's 3 years old, a loan that's 3 years old, a bank account that's 3 years old, utilities accounts, etc., etc. That is a good thing, okay? Now, the caveat over all of this, guys, is make sure, if you remember nothing else from this video, that you repay your payments on time. And we'll get onto this, but basically, late payments on any of those types of accounts is going to negatively affect your credit account seriously and have serious consequences. So remember that, okay? Also, having a high credit limit. So we talked about those credit accounts. And again, this one's going to be seem counterintuitive, but having a high credit limit, and I'm not talking about a credit limit of 20, 50, 100,000 pounds. I've looked at the various credit rating agencies, and anything above £1,000, so it could be literally £1,001, whatever. That is actually a positive effect on your credit score because it demonstrates again to lenders that other lenders are willing to lend you large-ish, amounts of money. If you only have credit limits under £1,000, that will signal to a mortgage lender that, hey, look, other lenders aren't willing to lend this person that much or an amount above £1,000. What's wrong? They're not a good candidate to lend to. Now, that might just be because you've said, look, I don't need £1,000. I only need 500, 250. But if you want to have a positive effect on your credit score, have at least one credit account that's above £1,000. Now, on the flip side, you don't want to have a credit limit that's too high. Okay, so I've said above £1,000. Now, if you have what is called a revolving credit facility, which basically means an overdraft. If you have a single overdraft above £15,000, now let's face it, most people don't have that, but if you have a single account above £15,000 and your total credit balances are above £30,000, it may decrease your credit score. It may decrease it, okay? And then also sticking with credit accounts, so I'm talking specifically about loans, overdrafts, credit cards. If you have too many, now it doesn't define how many is too many, but you know, lots. Let's use some common sense here. If you have like 6, 7 different credit cards and loans, okay, that can negatively affect your credit score. You want to have some, but you don't want to have too many, because then that indicates that you're reliant on debt and credit to live and basically fund your day-to-day spending. So it's all about balance with these credit accounts. And also a couple of the things that help your credit score is being on the electoral register, so being registered to vote. Even if you think, as I do as well, that the governments in this country have been an absolute shambles for the last 5 to 10 years, still vote, because it actually positively affects your credit score. And also having settled credit accounts. So if you've settled, and when I say settled, I basically mean you've paid it off over time. So if you had a loan that you paid off over the course of 3 or more years or a few years, credit cards that you've paid off, you know, don't forget to close some of these accounts. We talked about having a few open, not too many, but if you have one that you don't need, close it, okay? Because it basically says, draws a line under it on your credit score, and it says this person has had credit card or a loan for X years, they paid it off, they closed it, job done, tick, this person's reliable, they can do a credit facility from start to finish, and they're good for it, okay? And again, I'm gonna say again, no late payments, okay? And that also applies to utilities accounts. So if you've had, you know, gas, electricity, water at previous addresses where you've lived and you've paid it off, closed it down, and then moved, okay, that will show up as a settled utilities account, and that's a good thing for your credit score. Okay, now let's talk about some bad stuff that you really want to try not to do, just in general, because this applies to mortgages. This channel's all about property, but you know, your credit score is going to help you get mobile phone contracts. It's going to help you get credit cards, loans, jobs, you know, jobs check your credit score these days, and lots of other stuff. So it's really in your best interests to have a good, healthy credit score, okay? Late payments, we already touched on this, but this is number one, avoid them like the plague, okay? New credit account, try not to open a new credit account, so that's a new credit card, a new loan, balance transfer from one credit card to the other. You might think, oh, I'm just transferring my balance from one credit card to the other, I'm not actually taking out a new credit card, but you are actually taking out new credit, so avoid that. Even like utilities and mobile phone contracts, try and avoid those within 6 months of applying, okay, for a mortgage. So you don't want to have any recent new credit applications on your credit history, because this will negatively affect your score. And then lastly, this is a key one, when it comes to overdrafts and credit cards, it really is in your best interest to pay these off as much as you can, okay, month to month. So having 100% utilization, specifically of credit cards. So if you have a credit card and your limit is £1,000 and it's always at £1,000, you never pay it off, that's not a positive effect. It's actually a negative effect on your credit score, because it signals to lenders that you actually don't pay back your credit and your bills and you're reliant on debt, okay? So those are the main ones that I wanted to highlight. There might be lots of others, okay? There's lots of others. Put them in the comment section below, because I can't cover them all in this video, but those are some of the key ones that I've personally experienced and that I've seen through logging in to my personal credit accounts on Equifax, on Experian, on TransUnion, and seeing how they break down these components. Really important also, guys, to check your credit score. I'd be checking it, you know, if you're looking to apply, if you're looking to buy a property, start looking at months ahead, okay, of actually going out to valuations and starting to talk to brokers, mortgage lenders, because it's better to see stuff on your credit file that's negative early. Try and fix it before you come to actually doing that full underwriting. And you know, you can do a good amount of repairing on your credit score in 3 to 6 months. So be looking at your credit score regularly, full stop, but especially if you're coming up to looking at properties. So guys, I hope that helped. You know, mortgages and lenders, it really is a subjective area of property. You might get accepted for a mortgage by one lender and rejected for a mortgage by another lender. You know, you are the same, you haven't changed. You're looking at the same information, the exact same information, but a lot of these lenders have different criteria. So do the best you can in terms of what you can control to put yourself in a good position. Guys, thanks as always for watching and supporting. Please like and subscribe. Send this video, send this channel to people that you think would benefit, because that's how these channels grow. And I'll see you on the next one.